The government's latest 2024 spring budget has brought both bad news and good news for landlords. In this video, we're going to review the 4 tax changes impacting property investors, starting with the first significant change, the complete abolition of the furnished holiday let tax regime. This regime previously offered various tax benefits for those investing in furnished holiday lets, including capital allowances, mortgage interest relief, pension contributions, and the ability to split profits in joint ownership. Today, I want to focus specifically on the mortgage interest aspect. With this change, if you own a furnished holiday let or an Airbnb in your own name and it has a mortgage, you can no longer deduct your mortgage interest as an expense. Why does this matter? Well, losing the ability to deduct your mortgage interest means you'll end up paying more tax. Let me give you a basic example to illustrate how Section 24, which deals with mortgage interest, now works. If you own a property in your own name and you're a higher rate 40% taxpayer, here's what happens. Suppose your rental income is £1,000 a month and your mortgage interest payment is £500 a month. This leaves you with a pre-tax profit of £500. Previously, you would pay 40% tax on the £500, amounting to £200, leaving you with £300. However, with Section 24, you can no longer deduct mortgage interest as an expense. This means you're taxed on the full £1,000, not the £500 profit. With a 40% tax rate, your tax would be £400. Fortunately, the government offers 20% mortgage interest relief, which provides £100 back, reducing your tax payment to £300. This change results in you having £200 a month rather than £300 a month, a significant impact if you own multiple properties. This scenario highlights why limited companies may now be a better option for property investors. Section 24 doesn't apply to limited companies, allowing mortgage interest to be fully deductible. This difference means that with a corporate structure, your effective tax could be considerably lower, making it a more attractive option for holding properties. Moving on to planning permissions, there's a new classification coming into effect, C5 for short-term lets, including furnished holiday lets and Airbnb properties. This change will introduce new regulatory requirements, likely including stricter safety standards, which I actually think is a good thing. The second tax change involves abolishing the multiple dwellings relief, impacting those purchasing multiple properties in one single transaction. This relief, which previously offered a stamp duty discount, will no longer be available from June 2024. However, there is some good news with the third tax change regarding capital gains tax. The government is reducing the tax rate from 28% to 24% for higher rate taxpayers, aiming to stimulate market activity and encourage property transactions. Finally, the fourth change concerns VAT. The threshold for VAT registration has been raised from £85,000 to £90,000, which offers a bit more leeway for small business owners before they need to register for VAT, a minor but positive adjustment. In summary, while these changes present new challenges, they also offer opportunities to adapt and find more efficient ways to manage property investments. The key to success in property investment remains flexibility and staying informed about tax regulations and market conditions. I hope you found this video useful. Please remember to like and subscribe for more valuable content, and as always, I'll see you on the next one.